The program examines the complexity of cross-border real estate investing and the additional risks investors face when allocating capital internationally. International real estate investing offers diversification benefits, exposure to different economic cycles, and opportunities for enhanced returns through global market inefficiencies. However, investing across jurisdictions introduces complexities related to currency fluctuations, taxation, legal systems, political risk, and operational management. The program emphasizes that investors must understand both local real estate market conditions and broader macroeconomic influences affecting international capital flows. Cross-border real estate investments therefore require sophisticated risk management frameworks capable of addressing multiple layers of financial, operational, and regulatory uncertainty simultaneously. Currency hedging plays a critical role in cross-border real estate investing because foreign exchange movements can significantly affect investment returns. When investors purchase real estate assets denominated in foreign currencies, changes in exchange rates may either enhance or reduce returns when converted back into the investor's domestic currency. The program explains that hedging strategies are often implemented using forward contracts, currency futures, swaps, or options to reduce exchange rate volatility. Currency hedging may stabilize portfolio returns, but it also introduces costs and may reduce potential gains from favorable currency movements. Investors must therefore evaluate whether hedging is appropriate based on investment horizon, market outlook, interest rate differentials, and the relationship between currency fluctuations and underlying real estate performance. The program also explores currency risk and hedging within perfect market assumptions and alternative investment environments. In theoretical perfect markets, exchange rates and asset prices should adjust efficiently so that investors cannot systematically earn excess returns through currency exposure alone. However, real-world markets are imperfect because transaction costs, taxes, illiquidity, leverage, and behavioral factors affect pricing dynamics. Alternative investments such as private real estate may exhibit additional complexity because valuations adjust slowly and cash flows occur irregularly. Currency risk in leveraged real estate structures can become especially significant because debt obligations and rental income may be denominated in different currencies. Investors must therefore evaluate both asset-level currency exposures and financing-related foreign exchange risks within cross-border investment strategies. Accessing foreign assets with futures and quanto futures provides investors with additional tools for managing international exposure and currency risk. Currency futures allow investors to hedge or speculate on exchange rate movements associated with foreign investments. Quanto futures are specialized derivatives that provide exposure to foreign assets while fixing exchange rate conversion terms, thereby eliminating direct currency risk for the investor. The program highlights that these instruments can simplify international portfolio management and reduce foreign exchange uncertainty. However, derivative-based hedging strategies also introduce counterparty risk, rollover costs, basis risk, and potential leverage-related losses. Effective use of futures and quanto structures, therefore, requires careful understanding of derivative pricing, contract mechanics, and the interaction between currency markets and underlying asset performance. International real estate investing offers several strategic benefits, including geographic diversification, access to growing economies, inflation protection, and exposure to varying demographic and economic trends. Real estate markets across countries often differ significantly in property cycles, financing conditions, regulatory environments, and investor behavior. The program explains that investors may improve portfolio efficiency by allocating capital internationally because real estate returns are not perfectly correlated across regions. However, real estate taxation across jurisdictions can significantly affect net returns and investment structures. Investors must understand local tax rules related to property ownership, capital gains, income taxation, withholding taxes, and repatriation of profits. Tax complexity, therefore, becomes an important consideration when designing and evaluating international real estate investment strategies. The program concludes by emphasizing the numerous challenges associated with international real estate investing. Political instability, economic uncertainty, legal differences, information asymmetry, and operational inefficiencies can significantly increase investment risk. Transaction costs are often higher in global real estate markets due to taxes, brokerage fees, legal expenses, and financing constraints. Liquidity may also vary substantially across countries and property types, making asset sales difficult during adverse market conditions. Cultural differences and local market practices can further complicate property management and due diligence processes. Investors must therefore conduct extensive research, engage experienced local partners, and maintain robust risk management systems to navigate the complexity of cross-border real estate investing successfully and achieve sustainable long-term investment performance.